What to look for to not get scammed when buying signals, advice, etc. from the interwebs. Listen, I get it, you're into finance. But the truth is, learning the game is going to take time. By the game, I mean the game of finance, increasing wealth, etc. There are no shortcuts. This is especially true when people or companies or websites want to sell you signals or whatever to supposedly help you grow your portfolio. Now, whether it's a big name site with a bunch of credentialed stock traders or just some social media influencer, you need to know what to ask. You need to know what to ask for in return for your hard-earned capital for whatever those things, signals, etc. that they're trying to sell you. What do I mean by that? Well, first of all, you have to understand the motivation of the people that are selling you the signals, the tips, whatever. What do I mean by motivation? Well, understand that these individuals, companies, etc., they're looking for you to part with your hard-earned cash, the money you got in your pocket, and put it in their pocket and give it to them, really. That way, they have a constant flow of cash, which they can then use to trade with. Now, this is assuming that the individuals are legit and are actually trading cash and making profitable trades with that cash. Believe it or not, there are a ton of people out there who don't actually trade and are simply drumming up cash with little to no risk on their part, while at the same time faking the results that they get for their quote-unquote customers. Keep in mind, it is extremely easy to dummy up a screen of a trading app, and at the same time, to dummy up a positive and outlandish return on a particular trade or position using that same dummied up screen of a trading app. That's actually not very hard to do at all. There's probably a ton of templates and stuff out there, not even on the dark web, just the regular web, to do that exact same thing. What that individual or company or group of individuals could then do is take a screenshot or get someone else to take a screenshot of that very same trade that was made, and then claim that they made a killing on trade XYZ or really took over the market by taking this position, long position, short position, etc. ad nauseum. That's not to say that there aren't any true stories of that happening. The problem therein, is that usually that's the case of somebody, someone, some company getting lucky. And it's not usually the case that there's someone putting in a good strategy and getting that to work for them. See, there's a difference between getting lucky, putting in a good strategy, right? Getting lucky with your finances, basically winning the lottery, the $1 billion Powerball, or having a hunch on a stock, or the movement of a market, and then taking a position on that. Putting in the work, big difference. Putting in the work, there's a big difference there. Putting in the work is somebody who has a plan, starts a business, executes that plan, does the sales, does the legwork, comes up with the technology and implements it, and delivers a product and service to a customer, and maybe then gets bought out by a $1 billion firm, or then trades their stock on an IPO to then be worth billions of dollars, etc. That is executing a plan. That's not getting lucky. Similarly, somebody that wants to trade to make their money. They understand the technical analysis. They understand the quantitative analysis. They understand the fundamental analysis. They put any of those strategies to work. Overarching, high-level, 1,000-foot view strategies to work, that is. Pick a market, pick a segment, pick a company, pick a series of companies, markets, segments, etc. And then execute on those strategies to make their fortune. Oftentimes, they're taking a big risk. And just as often, the risk doesn't pan out exactly the way they thought it did. But they learn something along the way, and they're able to improve and tweak and adjust their strategy to continue to move in a positive direction. That is taking action on a plan, not getting lucky. How can you tell the difference between the two? Is there a way to know the individuals, companies, social media personalities? Is there a way to know if they're scamming you and just selling you the dream? Is there a way to know that these guys are legit? Well, actually there is. When considering the purchase of stock, crypto, commodities, forex signals, getting part of a trading group, paying to be part of a trading group, etc., paying for it from a provider of some sort, large or small, it's up to you to evaluate the performance and also their risk management strategies critically. And there are 5 key metrics that can help you to separate the scammers from the people implementing real strategies. I think one that a lot of people know about is the Sharpe ratio. This measures the performance of an investment compared to a risk-free asset after adjusting for its risk. It provides a snapshot of the potential excess returns you might receive for the extra volatility endured by holding a riskier asset. A higher Sharpe ratio indicates a more desirable risk-adjusted return. Another metric that you may want to look at and ask for from these providers of signals, trading groups, etc., is a maximum drawdown. This metric shows the largest peak to trough decline in the value of a portfolio over a specific period. It's crucial for you to understand the highest potential loss that you might face and the historical performance that this individual, company, group of people, etc. are asking you to participate in. A lower maximum drawdown is generally preferred as it indicates that losses from that investment peak, while they are smaller. Another metric you might want to consider is win rate or success rate. The win rate shows the percentage of trades or signals that are profitable. Now, while a high win rate can be attractive, it should be evaluated in conjunction with other metrics like risk to reward ratios, as a high win ratio also does not guarantee overall profitability. For example, if you invested $200 in Bitcoin in, let's say, 2014, you probably have a very high win rate because you made the right investment on the right asset at the right time. But if you only made that $200 investment at the time, but you also made investments at the peaks of Bitcoin as they fell, now your win rate is not looking as good as it could. So definitely something you want to keep an eye on, look into seriously. There's also the risk-reward ratio, talked about that a second ago. This ratio measures the potential reward of an investment and how it can be relative to its risk. A higher ratio is generally better, as I'm sure you know, indicating that potential returns are higher for every unit of risk taken. The acceptable risk-reward ratio can vary depending on individual risk tolerances and market conditions, and particularly your investment horizon. That is, how long it is you think you're going to be investing over the long term. If you're somebody who is nearing retirement, your risk-reward ratio should probably be lower. If you're somebody who's very young, like just starting out in the investment world, 15 to 25, a higher risk-reward ratio is probably something you want to look into. You definitely want to consider the consistency of performance of whomever is trying to sell you these signals, this group, etc. Consistency in performance over different market conditions is crucial. This involves looking at the annual or quarterly returns to assess how stable the provider's performance has been over time. Now, consistent returns across various market environments. Proven consistent return over various market environments. That can indicate a robust strategy that is less likely to be affected by market volatility. One thing you're going to want to make sure you do is to remember to ask for all these metrics and more. Maybe some that I haven't thought of, maybe some that you've thought of. Put some down in the description down below. Asking for these metrics is key. If you ask for these metrics and someone doesn't want to give them to you, that is a signal from them that what they're trying to sell you is a dream, a pipe dream, really, and that they're not really selling you good investment advice. Even then, it's important to remember that past performance is not always indicative of future results. These metrics, all of them, they indicate what someone has done in the past, not what their strategy is going to do in the near future or the long-term future. And in reality, it's always going to come back down to you, making sure you do your due diligence to make sure that the investments that you're going to invest in are the right ones for your risk tolerance, for your understanding of the market conditions, and for your understanding of the products and asset classes that you're purchasing. Don't be afraid to ask the tough questions, the kind of tough questions that we answer here on this channel. With that in mind, if you got any value out of this video, like, subscribe, click the notification bell. I'm Derek West. This is Finance Squared. Remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'll catch you next video. Peace.